Oil just dropped 5% in a single day. Not because of a recession, not because demand collapsed, because of a phone call. Let me give you the full picture, because this is one of the most important macro setups we have seen in years. For the past 3.5 months, the world has been watching one of the most dramatic geopolitical standoffs in recent memory. Back in late February, the US and Israel launched a joint military campaign targeting Iranian assets. Iran responded by doing something no country had done in modern history at this scale. They closed the Strait of Hormuz. Now here's why that matters to you as an investor, even if you have never touched an oil trade in your life. The Strait of Hormuz is the narrow waterway that carries roughly 1/5 of the world's entire oil supply. 1/5. That's not a small number. That is the artery that keeps global energy flowing. Factories, shipping, airlines, heating, all of it runs downstream of that one choke point. At the peak of the tensions, Brent crude was trading above $110 a barrel. Analysts at major banks were floating scenarios of $150, even $200 per barrel if the closure held. The war premium, the extra cost baked into every barrel purely because of fear, had added nearly $30 to the price of oil. And then on Sunday night, everything changed. Trump announced the US and Iran had reached a deal. The Strait of Hormuz would reopen. The naval blockade would be lifted. A formal signing ceremony was set for Friday in Switzerland. Markets absolutely exploded. Stocks surged, oil dropped, bond yields fell. But here's where most retail investors made a mistake this week. They saw oil drop and they panicked and sold their energy positions. Or they saw markets surge and they chased the rally at the top. Both moves, based on the chart, look like traps. Here's what the media is telling everyone right now. Deal is done. War is over. Oil goes back to where it was. Energy stocks collapse. Growth stocks take over. Time to rotate. That's the narrative, and it sounds logical, but there are 3 things the headlines are glossing over. Now look at what happened every single time Trump signaled de-escalation during this conflict. The first time Trump delayed strikes on Iran's energy infrastructure, WTI dropped more than 10% in a single session. That was the first signal. Each ceasefire signal, each diplomatic hint. The market sold the war premium immediately and aggressively. And now with the full deal announced, Brent dropped more than 5% and slipped below $83. So here's the key technical question every energy investor needs to answer right now. Is this the bottom for oil? Or is there more downside coming? Before this conflict started, oil was trading in the mid to high 70s. That pre-war price level is now the key support zone to watch. Now pull up the Israeli TA35 index on TASE. Look at Monday's move. Israeli stocks rallied on the deal news, but notice that rally is tentative. The index has not broken out to new highs. It is sitting right at a decision level. The market is not fully convinced this deal holds. That hesitation is important information. This is where the GimmeEdge ProTools indicator became genuinely useful on this setup. Overlay the indicator on the WTI chart and go back to late February when the conflict started. The momentum zone shifted immediately. The decision level flipped from neutral to bullish on oil, before most retail traders had even read the headlines properly. The 3-zone framework flagged the war premium accumulation phase in early, and here is the critical part. It also flagged the distribution phase starting in mid-March, as Trump's diplomatic signals started coming through. Retail traders were still bullish on oil in March because the news was still scary. The indicator was already showing momentum fading at the top. Now look at the current setup. With oil dropping sharply on the deal news, the indicator is sitting at a key inflection point. The momentum zone has shifted, but the decision level has not yet confirmed a new sustained downtrend. 3 turns on this chart. 3 times the indicator flagged the move before the crowd arrived. The February spike, the March correction, the April rally back above 110. Each one called before the mainstream narrative caught up. So what is the actual takeaway here? Number 1, a deal announcement is not the same as a deal being done. This is a 60-day memorandum with unresolved nuclear questions, an Israel that has explicitly opted out, and Iran watching every move in Lebanon. The market moved on optimism. The risk has not disappeared. Number 2, the war premium in oil is real, and it is unwinding. But the pace and the floor of that unwind depends entirely on whether this deal survives the next 60 days. Watch the 60-day clock, watch Israel, watch Lebanon. Number 3, the biggest mistake retail investors make in setups like this is reacting to headlines instead of reading price action. The chart already told you oil was distributing before the deal was announced. As always, this is not financial advice. This is purely educational analysis. Past chart behavior does not guarantee future results. If this kind of analysis is useful to you, where the chart tells the story before the news does, the indicator used in this analysis is linked in the description below. And if you want to be here for the 60-day update, because this story is absolutely not over, hitting subscribe means you won't miss the next chapter. The nuclear deadline, the Israel wildcard, and the oil chart are all going to tell us something very important over the next 2 months. We will be watching all of it.